Well, the inception of our program was in 2008, actually last quarter of 2007, but I showed up in 2008. I immediately halted any investment in any real estate equity because I saw the writing on the wall. Instead, we diverted our attention to infrastructure because I was allowed to do that also under my domain. So we did some infrastructure investing first, and then when we started doing real estate and got back involved in that, we started going through the debt side of the house. So we did a lot of distressed debt, NPLs, large monolithic groups that were buying huge packages that they could work out over time, as well as some smaller companies that could go for assets that were too small for the larger firms to consider due to their cost of doing business. Over time, up to about 2011, we started putting equity into the ground. I was specifically tasking my consultants with looking at deals that were driven by demographics and not by the availability of easy money like the prior decade. So we looked at senior housing, we looked at apartments. We decided to use senior housing as our proxy for apartments as our first equity check in the ground, and then began expanding across value add and opportunistic from there. Well, how we maintain flexibility in our real estate portfolio and our broader real assets portfolio, what we've done is we went back to our board and to our investment committee and asked to take our ranges down to 0. So we can go 0 to 40, 0 to 60 on different components of real estate, as well as different components of agriculture, timber, and infrastructure. So we have the flexibility of being able to rotate through each one of those on a tactical basis or strategic basis, instead of having to be stuck to having a certain percentage in core or a certain percentage in value add. That we believe that drives bad decision-making processes. If I have to have 60% in core, then I'm making buying decisions based on the allocation and not on the practical sense of investing in an area that is most attractive at that particular point in time. I have to tell you a little bit of my personal history. My family goes back in 1951 in Merrill Lynch, so I grew up in the industry of watching people marketing products to others. In terms of Merrill Lynch, I saw them packaging products specifically because there was market demand, not because there was actually a good reason to buy that asset. So that's led to me to have a bias against large shops to begin with. Next is I really like developing long-term relationships with people, and I like having a catalyst type of relationship where I can help them get to where they need to go. One of the reasons for that is I know I can get better returns profile there. If I'm going with larger shops, I mean, if you take a look at various different studies, the return persistence on fund managers isn't all that attractive. I mean, their first fund was good. That helped them raise more money for their second fund, which was large. And by their third fund, they're getting so huge they can't actually execute in the manner they used to because they had to scale up and couldn't maintain that corporate culture. So that frequently winds up creating a decay in their performance. And so you see more spotty return profiles. With a smaller manager, they have a lot more control over their destiny. And that's that part of their growth curve in their institution that I want to be involved in. It winds up creating a long-term relationship where, for example, one of my consultants had a foundational investment in a fund manager. 10 years later, when I'm his client, that benefit inured to me. I was able to get a seat on an advisory committee I wouldn't otherwise have been able to get, and was able to get information flow out of the manager that I would have not otherwise been able to get if I had not had a consultant who had a very long-term relationship with that GP. So we look for a stronger relationship and where our money makes a difference. If we're a $30 or $50 million piece of swat of money for a multi-billion-dollar manager or a manager with hundreds of billions of dollars, we mean absolutely nothing to that group, no matter how much they say that we do. So, but if I'm 30 million to a group with 400 million, I know that when I call, they will return my call. I know I'm going to have a very responsive relationship. I know they appreciate our money, and a lot of other dynamics that lead to, in my belief, a much more fruitful relationship.